All we're doing is going over number one. The first 10 minutes is going to be just a quick, brief little thing about how you can go right into this with a fresh start, not trying to have every ICT thing in the repertoire. Just simply going in and how do you take rate? How do you watch price action, looking for certain things? If you're brand new to what it is that I teach, now this is like the crash course today, right to the point. So on the left-hand side, we have the daily chart of the E-mini NASDAQ, and on the right-hand side is a 1-minute chart. Now, if you notice in the lower right-hand corner, I have it set to electronic trading hours, okay? I'm going to toggle to regular trading hours. Here we have Tuesday, yesterday, regular trading hours. In other words, where you would see the end of like day session hours, and then it would resume trading still with electronic trading hours. But you're not seeing anything past this on this perspective until at 9:30, wherever we open up, then there'll be a new price chart or bar start populating the chart. Right now, I have it toggled where it's not being shown. So now if I do that, that's my regular trading hours opening range high. What you're gonna do is you're gonna align segment, horizontal array, and you find the 4:14 p.m. Always set your chart to New York time. You would take the horizontal array and just drop it right on the close of that last candle. And now also the new day opening gap high for Wednesday's trading, which is going to be determined by the close at 5 p.m. Eastern time Tuesday and the Tuesday 6 p.m. electronic trading hours restart time. So there's a 1 hour difference between that last print at 5 p.m. Eastern time and 6 p.m. Eastern time. We call that the new day opening gap. And I have this toggled to high. So I'm going to put that on the chart here and then the low. Now it's showing on a regular trading hours chart. So we're going to toggle over to electronic trading hours and I'll let you see real quick where this is at. Okay, it's right there. So this is the last print at 4:59 p.m. on Tuesday. And then at 6 o'clock, it opens up here. See that? So there's an hour difference between this candle and that candle. Technically, it's an hour and 1 minute, but it's showing you the last print because 5 o'clock, there is no trading. So it's not going to show you a print at 5 o'clock. So last print is going to be 4:59, as you see down here in the bottom of the chart. So you want to note that with a horizontal array. And then where we opened at 6 o'clock, that's if it's higher than where we closed, then this is the high and that's the low. Then you have a premium new day opening gap. And now, what's the benefit of having that? If you look at the new day opening gap, it's above us right now. And I like these relative equal highs. So I'm watching this today, this morning with you. So now think about what we have here. We have regular trading hours opening range high, which is where we closed regular trading hours yesterday at 4:14 p.m. Eastern time. We're below that. We're below new day opening gap, and we have minor buy side up here. So we already out the gate, we have three things going in our favor where it could likely push higher to explore and probe reaching for buy side liquidity. That does not mean it cannot drop. It can. But I start the day off with the expectation of where can it reach to? Because if you're going to start learning how to read the tape before you even trade, before you ever put any risk on, ever, you need to know what you're looking at, what you're studying, why should the market behave a certain way, and without having at least a baseline of certain basic principles of where the market will be drawn to, where is it likely to be pulled into for liquidity. There's orders, and then there's inefficiencies where the market will book price in that particular range because it hadn't spent enough time sufficiently offering buy side and sell side delivery. That's not liquidity. It's passing through a predetermined range. And I'll explain that in a couple minutes. But right now, I want to show you also the Monday, Tuesday regular trading hours opening range gap. We'll highlight that on the chart too. And that is going to be seen here. All I'm doing is going over the last 3 days or so. Okay. Here is Monday's regular trading hours close at 4:14 p.m. Eastern time. So it's highlighted right there. And then we opened at what? 9:30 a.m. So this is regular trading hours opening range gap. So this is measuring the difference or disparity between where we closed yesterday at 4:15 p.m. Eastern time and where we reopen for regular trading hours at 9:30 Eastern time in the morning. So between those two times, electronic trading hours is taking place, with the exception of the small window of 1 hour between 5 p.m. Eastern time and 6 p.m. Eastern time. Okay. And real quick, I'll let you see what this has done. You can see the reaction here. Electronic trading, I'll just go here. You can see the reaction there, there, and again, it's above us as well. Okay. So Friday to Monday, regular trading hours, quadrants, we'll show that in a second, but right now I'm going to add that. So what this is doing is showing the entirety of the separation, which was a huge gap in regular trading hours for Friday. It's closed where we opened up Monday morning at 9:30. So here's Friday's last print on regular trading hours at 4:14 p.m. Eastern time, and then here's 9:30 opening on Monday. So that difference there. Now I'm going to showcase the quadrant levels. Now I didn't put the midpoint or consequent encroachment level because I'm using the label to draw my focus to where half of that would be. And we're going to go back to this, and you can see how that pretty pretty well gives us the midpoint or consequent encroachment of the gaps midpoint between Friday and Monday's opening. So Friday close regular trading hours, Monday regular trading hours open. That's the opening range gap. But we have several things that could potentially give us reason to go up here. Now, caveat, looking at the economic calendar, you'll notice today at 10 o'clock, we have a red folder or a high impact news driver. That's what we have at 10 o'clock. Okay, so that might be the fuel, if you will, that injects the volatility in the marketplace to send us up into exploring any of these things up here. It need not. Here's the real important thing. Okay, when you're first starting out, the first thing you want to do is give yourself permission to be wrong. Don't expect, and we're opening at 9:30 now. Don't expect to be right. Don't expect to know everything that's going to happen next. You don't know that. Okay. In the beginning, it's unrealistic and unreasonable for you to feel that way. Okay. Notice that we're trading at the low of the Friday to Monday opening range gap. We're trading right down here, and we just took that short-term low out right there. See that? Notice this little reaction here. It doesn't mean it's going to go straight up, but I like to see these types of things. These are encouraging for when you're watching the tape and when students are watching price. It's really nice to see it react that way. Minor buy side is here. And then you have a little bit more buy side here. And then we start going into the levels I gave you this morning. Now, without having Friday to Monday opening range gap on your chart and not knowing that that level is down there, this would be completely invisible to you. You would never expect that. You would just see it. Well, it broke support because classic support and resistance guys see that. So it went down here and went up before. So therefore, if it does that, but then it went through it, that's going to scare them. They're not going to want to take a long there. But that's not what we do. We're looking for what? We're looking for the draw on liquidity to go to not just one thing, not one little ICT gimmick or trick, okay, a PD array. We want several things to indicate to us that we have probabilities in our favor that the market's likely to pull in one direction over another. Now, if at any time you're ever watching price, you want several things. There's the buy side I told you I liked. There's those highs I told you about, okay? And what do we return back into here? The Monday, Tuesday, regular trading hours, opening range gap, right there. That in and of itself, you got two things you just delivered. If you had longed the market and did a soup long, in other words, buying below that low, right now you could be offsetting some of that long position, leaving something on as a runner in case you get up into the Wednesday new day opening gap, or if it goes up into um, the regular trading hours opening range gap high. Now, because I'm trying to teach so much over live price action, I forgot to tell you this part. You want to do at the opening at 9:30. Here's that candlestick right here. We're on electronic trading hours, okay? Here's the opening price. That's where we first printed at 9:30. In other words, regular trading hours started right there. I'm going to put it on the chart here, but I'm going to toggle to regular trading hours. See the difference where we were here and we opened all the way down here, right at that price. So now what I'm doing is I'm going to take this off and I'm going to copy this one, whatever array or whatever your annotation is at the time. As soon as you get the opening price, you want to annotate it and then draw your fib in to grade that So we open down here, and I teach algorithmically, the market will go back to half of the opening range gap 70% of the time. What if you had 70% likelihood that you were going to be correct and win? Wouldn't that be amazing? That'd be an amazing testament to you luck, right? Well, luck doesn't exist. Okay, you have to make your own luck. Okay, and by having very simple little strategies, right to the point. Okay, knowing where the halfway point is right here. If it opens up down here, there's a 70% likelihood that the market's going to go up to this level here before or by 10 a.m. Eastern time. In other words, in 30 minutes, it's going to go there. Notice we traded up into the Wednesday new day opening gap low. Now, again, take something off. Okay, scale off. If you don't know where these levels are beforehand, you are gambling with no luck. You have nothing in terms of probability in your favor. Zero. So anyway, now we've had the market deliver like gangbusters right off the PD array that I already had in mind and showed to you. And the market hit it, ran up, and drew up into the first buy sell liquidity I told you about. The second one, which is Monday and Tuesday's regular trading hours opening range gap. The Wednesday new day opening gap, which is determined by 5 p.m. Eastern time and 6 p.m. Eastern time. And then I gave you quadrants on this Friday, Monday, this big gray area here. That's the lower quadrant. Halfway point is right here, or consequent encroachment. The upper quadrant is here. And then here's the high of it. If you cut bait and say, I'm done for the day, and don't even expect or require it go all the way back to this price here, because that's with the exception of going to the high of Friday, Monday's opening range gap high, which is this level here. That, and then if it goes there and higher, the gap closure or gap fill is trading back to previous days, regular trading hours close, because we opened down here and the market's drawn back up into it. So what I want you to think about it is like this. Price stopped here and it opened right there. So what you're seeing is essentially the market created this gap from where we stopped trading yesterday at 4:14 p.m. Eastern time. Regular trading hours close, and then regular trading hours open at 9:30 today, this morning. It opened down here. So there's a vacuum. There's an absence. There's a void. There's a complete and utter wasteland or empty canvas for price to paint all over. And it's inside that yellow box. That vacuum seal is broken, and then price rushes right back in to fill this expanse of empty, no price action. So that's your first steps in knowing where the market's going to go at the open. Here, this is kindergarten ICT. This is how simple you can start. For now, just know that your first priority as a student of price action, learning how to read price through the language I created in Smart Money Concepts, simply knowing specific reference points. Now, but if you agree that this is simple, it's very, very straight to the point. It's not complex. It's not complicated. And it's friggin' perfect. It's precise. There's no ambiguity about it. There's no guessing about it. It's just you're building a narrative that why price should go a direction versus another direction. In other words, is it going to go up or is it going to go down? Because that's all we have to first consider. Is it likely to go up? Is it likely to go down? And you build the evidence to suggest one side over the other. My PD arrays are going to scream at you. Listen, look at me. There's a whole lot of interest up here when you have all these PD arrays where we're opening below it. So where's it going to go? Up. Now, it does not mean at all that the market's going to continuously go up and have an all-time high today. I mean, it can, but I'm not saying that here. I'm trying to get you to think about it in a graduated approach where you take a reasonable amount of information that should not be, in my opinion, this should not be overwhelming. You see the low of the session today right there, only by a tick off. Isn't that amazing? That's the range between Friday and Monday's opening range gap. See, everybody else knows about gaps. You hear the adage, gaps like to get filled. Oh, mind the gap. Oh, guys, gap filling event. Oh, it's probably going to go to the gap. It's going to close the gap. It's going to close the gap. We already closed that gap, but it's not done using it. because there's an algorithm that refers right back to that price level. What price level? This level that I showed you. This level here, the lower quadrant of it, the midpoint of it, consequent encroachment, then the upper quadrant here, and then the high of it. See, everybody has archaic principles. They know about gaps. And once the gap fills, they discard it. They throw it away. It's no longer useful. It's no longer salient to them. So they're looking for the next thing to chase. Now, where do you think the market wants to reach to now? It's already pulled back into three-quarters of the gap, which is that upper quadrant right here. There's liquidity resting right on here. Right below here. What's below that? That's sell side. So your initial expectation would be try to see how far you can get up into half the gap. 70% likelihood it's going to go there. Then three-quarters of the gap. It does not need to fill that. Does not need to do that at all. And we're seeing the rotation lower with liquidity resting right below here. There's no sell side outside of that low. That's the only sell sides in the marketplace, and it's tapped into it there. So now it's probing. Do we see a continuation lower? If it really starts to find some weight in it and keep going lower, and this stays open here, then that might be impactful for a PM session. But let me get this rectangle off here. This was straight to the point. It was not complicated. I gave you the levels beforehand. I told you the direction we would be expecting beforehand, and it delivered perfectly. If you can't do this part here consistently, in other words, find one section of the marketplace where you're going to see an obvious price run. If you can't do this, you can't make money trading. But I want you to know that there's a way of doing this. It's not hard. It's impossible if you try to put everything I've ever taught into a repertoire with no experience. And that just went right over your head. And for the folks that are brand new, this is how you start. You simply grab a couple tools, a new day opening gap, the opening range gaps over the last 3 days, put them on your chart. And then look for relative equal highs. Where is it clean? Very, very smooth edges. That's this level I told you here. On this time frame, I got to go to the electronic trading hours chart. So these clean highs up here, I mentioned how I liked them earlier, right at the beginning of the stream. See that? And then once we ran the sell side out below that low, now we're right back up to those same equal highs again. See that? So both liquidity and the PD arrays I gave you, which are all these things up here, think of this as this collection of lines and ranges I told you about. Think about that as a big magnet, okay? A really big magnet. And think about every 15-second candlestick. Think about that as a paper clip, okay? And it starts down here. And you're dropping these paper clips underneath a magnet, a really strong magnet, and you start spilling them out of a cup like this. They start spilling out of a cup, and they initially start falling because of gravity, but eventually what happens? The magnetism, the field of magnetic or magnetism, pulls what those paper clips up. They get raptured. See that get sucked right back up into a level where the field of magnetism is the strongest. And where's that going to be at? Technically, in the PD arrays that I showed you in the chart, right? Up here, all these things. These are all. This is like the magnet. And notice that Monday, Tuesday, regular trading hours, opening range gap. Look where the bodies are really collecting right there. So consequent encroachment of that range right there, I think, is like the core. Like that's the big draw. Now you see people that talk about like volume profile, and they'll see point of control and those types of things. This is the real point of control. You just need to know where can the market be drawn to next. Why should it be drawn there? And is it more than one reason for it to happen? Because the more things that you can stack in your favor, it becomes so overwhelmingly one-sided, it's high probability. So now look at the daily chart over here. Okay, we came off these lows really hard. We came up, swiped that minor buy side of liquidity, and now we're going to get the news reaction here. There's a portion of the opening range gap for today that's not closed. In other words, that's this level up here, this regular trading hours opening range high, or yesterday's regular trading hours close. So we've had a low form in the first 2 minutes of trading, rally up, pulls up into the levels I told you about, We came back down, took the sell side liquidity, resting below that low, hit that, came right back up into the range, went back into that old liquidity pool, which is what I teach you to do. This is not support and resistance. You're going back to that level because it was an area where the algorithm. Now, here's where you write this stuff down. How is price going to know where to go to next for liquidity? Because just like you see on level two data and depth of market and ladders and whatnot, there can be spoofing. And spoofing is where someone with deep pockets can put like a block of 500 contracts that they want to buy above here. Okay. It'll sit there, but if they're not really wanting to buy that, when it starts trading getting close like that, they'll pull that order. It won't be there. So they ghost that whole entire order. But they know a lot of you jacklegs out there that believe in this religion of level two data. You'll see that and you'll say, "Oh wow, there's a buyer at 500 contracts," and you think they knew something that you don't. And really, what we're doing is we're laying bait because we know retail traders like you are going to look at that and be enticed to do what? Think about it. What are you going to do? You're going to buy on a breakout. Okay. You're going to expect it to get up there. You'll buy it and hope it breaks through and keeps going higher. In the difference between where it's at now and where it's going to go if it goes up here and trade where that 500 block was being spoofed. Spoofed is not really the intention of being filled at that price. They're just placing you, just like you can put an order in. You can put an order in to buy on a stop up here. Anybody can do that. But when they are being shown on level two data, it's a form of manipulation. It entices other traders with less informed psyche. They have no idea what to anticipate in price. You're literally being tricked. You're being baited to chase these big blocks. But you don't need that stuff. And the algorithm doesn't need to know the actual number either. That's why I said the algorithm doesn't know where your stop is literally, and it doesn't know where my stop is. It doesn't. It just knows where old highs are, where you're going to place that buy stop, or where that old low is, where you're going to place that sell stop. You see how easy it is for a coder to put the language in to go back to a reference point? Go back a number of periods. Okay, what is that period? Well, referencing on a 1 minute chart, that low here, when we were trading here, I said it's going to go down, hit the sell side there. Boom. Wait and see if it gets weighty. Does it get heavy? No. It comes right back into the range. It comes right back in one here and then sends us right back to the old buy side liquidity pool. What is it referencing here? This old high right here. These are Asia highs. They're relatively clean levels. So that prolonged period of consolidation where it's real smooth like that, whenever it does that, you're going to get multiple times that it's going to probe that same level. Buying and selling pressure is not pushing it there. The algorithm keeps offering it there. The algorithm is an AI. It used to be a collection of men, but it's efficient now to have a structure just like Pac-Man. Pac-Man starts his game here. He goes down, eats the power dot below here. Now he can run and go after the ghosts. Where's the ghosts? Anybody that's short and has their orders up here. Goes up there and eats up all of the ghosts. And then where he needs more power. So where's he going to get more power from? He's got to go down below that low here because there's a power dot below that. And Pac-Man or Price goes from this area after it eats up all these ghosts. It needs more power. So it goes back down and eats the liquidity below that low. Once it gets that, then it's energized again. Where's it going to go? Well, if it came down here and it isn't going to keep dropping, what do you look for? Old highs. Now, old highs is not just that. It's the ones I just showed you in Asia. That's an old high because I'm not supply and demand. I cut through ranges. That's what the algorithm does. The algorithm is going to refer back to old price data that's pertinent to right now because it's inside this range. And now this high here. It rallies up, takes that here, and it's also sweeping above where that minor buy side liquidity pool is. If you strip away everything I said today and you just simply looked at price, retail traders look at that and they are scratching their head thinking, how are people trading that? And I omit, if you don't have any narrative skills, no idea of referencing where liquidity is, how price is going to use old reference points, this right here, this is complicated. It's very complicated because how can you make any heads or tails out of this back and forth gyration? But I laid down the map before we even started today. I gave it to you And it's using tools that I've handled for 3 decades. I've kept this stuff guarded for a long, long time. And I have looked at all of you through my screens for years, watching you fall victim to this stuff. And I've gifted it to the community. But you just go in and you take bite-sized bites of it, okay? Digest as much as you can. Don't try to do too much at one time. Don't try to do like 4 videos over the weekend. Just pick one. So that way that you know that you know. And if you rush through a number of videos, you're gonna have questions that you're gonna feel like they never were answered, or I will never be able to answer because so many people ask me all the time, "Can you do this? Can you do that?" It's in the videos. 99.9% of the things that you're gonna ask me is already out there. It's in my YouTube channel. It's literally right there. All you have to do is pull up your sleeves and start watching any one of those playlists. Just pick one. Just start somewhere because they're gonna overlap. Everything gets talked about in other places again because it needs to have repetition.